Chapter 3 of the financial accounting textbook talks about adjusting the accounts. So we do it in order to maintain our generally accepted accounting principles, which require us to use accrual basis accounting, so that we have to charge off expenses in the period in which they are incurred to offset the revenue in which they created. And so that's kind of what accrual basis is. So if we look down below, what it shows us is that we have different economic lives that we use to prepare our financial statements. So we may do it monthly, just January. We may do it quarterly, which would be the first 3 months of the year. And then we definitely do it for the whole year end. So most companies, most large companies do each. They do a monthly financial statement, they do quarterly financial statements, and then they do annual. So a lot of companies, a lot of companies are the calendar year, which runs, January 1st through December 1st. But some large companies have changed to be a different closing, and so their fiscal year is different than the calendar year. So maybe their accounting year ends on March 31st or February 28th. So then they're going to go from, February or March 1st of one year to February 28th of the next, and that would be considered their fiscal year. Again, and sometimes the fiscal year equals a calendar year. It just depends on the company. When we break those time periods down, like back what we had on the last slide where we said they prepare monthly statements, quarterly statements, those are called interim periods. Accrual versus cash accounting. So accrual basis accounting, again, we're trying to recognize the revenues when we perform the services and then recognize those expenses as they're incurred. So we don't really follow cash basis if we're following GAAP. If it's a very small business, like a self-employed person, they may follow cash basis. As they pay it, they charge off the expense, and as they receive the cash, they record the income. But large publicly traded companies follow GAAP, generally accepted accounting principles, and use accrual-based accounting. So again, the cash basis would just be that as the cash comes in or goes out, that's when you record it, but that is not generally accepted accounting principles. Our revenue recognition principle is stating that we want to recognize the revenue in the period that it was earned, or that obligation was satisfied or performed. That's kind of the key. So it doesn't necessarily have to tie to when the cash comes in, just when the work is done. And then the same with expenses. We want to put those in the period in which they are used up, or that they're used to create the revenue. So the expenses should normally follow the revenue that was used, that was created when those expenses were used. So the revenues and the expenses match in the same period. So here's our different principles and assumptions. So our time period assumption is that we break the business into these artificial time periods: monthly, quarterly, annually. Revenue recognition principle says that we recognize revenue in the accounting period that the services were actually performed. The revenue and expense recognition is that we are following generally accepted accounting principles, and that we are going to recognize the revenue when we earn it, and we are going to recognize the expense when it's incurred, and the expenses go in the periods that the efforts are made to generate the income. So we're matching the expense to the income. We have adjusting entries that are needed at the end of each accounting cycle, or each interim period, and those are to ensure that those revenues are recognized when they're supposed to be, and the expenses are recorded when they're actually incurred. And it's necessary because, again, we want our trial balance to be as up to date and accurate as possible. And if we don't have, say, the invoice yet for an expense that's incurred, but we know that we incurred it, that's an example of something that may need to be adjusted. And we do it every time we prepare our financial statements, and it's going to include our income statement and our balance sheet. So here's our different types of adjusting entries. So I already gave you an example of one of them, but so we have deferrals and we have accruals. So deferrals are when we have prepaid expenses. So we've paid in cash before we've actually consumed them or used them. So sometimes your insurance comes in an annual bill. So you pay it February 1st and it's for the whole year. So that's going to go to prepaid insurance. And then we're going to have an adjusting entry at the end of each month using up 1 month of that insurance. So each month we'll charge, whatever the 1/12 of that annual payment was to insurance expense, and then we credit that prepaid insurance. So we're taking it out of the prepaid insurance each month and charging it off to expense. Unearned revenues happen if we receive the cash before the services are performed. So, maybe we are a pool that's open for the summer and people come in and they buy season passes. So, maybe May 1st, we get all of our money. We get these big chunks of money in, but we haven't earned it yet. We haven't done anything. The pool maybe isn't even open. So those are going to go to unearned revenues. But then as the months go on and the people come and they use the pool and we're earning those revenues, we're going to take them out of unearned revenues and we are going to credit our income. So when they're in unearned income or unearned revenues, they are a liability. We owe those people a service. Our accruals are things that we know have happened, but we maybe haven't gotten the paperwork to actually record them yet. So like accrued revenues, or we know that we've earned revenues, but we either haven't received the cash or we haven't prepared the invoice to the customer. But we're going to go ahead and record those via a journal entry, an adjusting entry, so that our financial statements are accurate. Same with the expenses. We know we've incurred an expense, but we haven't gotten an invoice from our vendor. So we know we've gotten goods in, we've checked them in, we see them, there's, our supplies are sitting there, but there's no invoice. So then we're going to want to do an adjusting entry that debits the supplies and credits the accounts payable, even if we don't have the invoice yet. Here's an example of the trial balance. So again, each account is going to be looked at to make sure it's accurate and see if there's any adjusting entries that need to be made. So then we have our deferrals. If we look through our little stages of what we're doing, so once we look at our trial balance, we say, okay, here we realize that there's going to be some expenses that we need to record, revenues that we need to record. So we're going to have to do some adjusting entries. Whoops, sorry. So I'm too quick with those buttons. So we've got the payments of expenses that'll benefit more than one accounting period. So like I said, those are our prepaid. So we have possibly prepaid insurance. We may buy a whole bunch of supplies and only, use them periodically. So we may have almost like an inventory of supplies, and we're going to use those we're going to charge those off to expense as they are used. Advertising, we may have to pay the agency for a whole year's advertising, but really the commercials or the in-print ads or whatever it is are going to go throughout that year. Rent, we may pay our rent quarterly or annually. Annually would be a lot, but we could. And then buildings and equipments those aren't prepaids like what I've explained before, but those are assets that are used up over time. What we call that is depreciation. So if we have a piece of equipment and we think, like a car, we've got a car, we estimate the life of that car is 5 years or 7 years. Well, every year we use it, it goes down in value. So we need to adjust that value and record the expense as we use it up. So here we have, again, that costs that expire through the passage of time or through use, both of the ones that I just explained on that last slide. And our entry for these types of things is we are going to credit the prepaid account, which is currently in an asset, and then we're going to debit the related expense. So here we have an example. Pioneer Advertising purchased supplies of $2,500. They recorded that purchase by setting up an asset called supplies, and the account has a balance of $2,500 on the October 31st trial balance. However, when we go out and actually look at what's still on hand, it reveals that only $1,000 of those supplies are on hand. So that must mean that we used $1,500. So we bought $2,500. At the end of the month, all that's left is $1,000. So we are going to have to record an entry to charge off what we used to expense. So that's our debit to expense, and then reduce the balance that's in the supplies account. So again, it started at $2,500. When we credit it, we are reducing it, which will bring its balance down to the $1,000 that's actually on hand. Okay, then we have they paid for a $600 1-year fire insurance policy, and that was on October 1st. We're now at October 31st, and we realize that we have to charge that off to expense, 1 month of it. So we take the total we pay, divide it by 12 to get that 1 month amount, and we debit insurance expense, and we credit the prepaid. And here kind of shows you like we're going to do that every single month until we get to the end of the year and we've completely charged all of it off to expense. Depreciation is what I was explaining with the buildings and the equipment and the motor vehicles, things that are assets that are not land. Land does not depreciate. Everything else depreciates. And depreciation is just the process of taking the cost of that asset and allocating it out to expense over its useful life. We don't really try to figure out, well, how much value did it really reduce? It's not like we're going to have it appraised at the start of the year and the end of the year. It's just a systematic way to do it, to charge that off to expense. So here's an example. So we've got depreciation on the equipment at $480 a year, which is going to be $40 a month. So every single month we will do an adjusting entry where we debit depreciation expense for $40, and we don't credit equipment. We always want to leave equipment at whatever its historical cost was. We set up this account, which is accumulated depreciation equipment, and that's a contra account. And you'll want to know that term. So a contra account is an account that is its balance, its normal balance is opposite what we would expect it to be. So it's in the asset section of the balance sheet. So we would expect it to have a debit balance. Since it's a contra account, it's going to have a credit. And when we look at our balance sheet, we'll always have our equipment at the cost that we paid, and then right below it, we'll have this accumulated depreciation, and then that's going to be, dash equipment. And that's going to be effectively reducing that value over time. So here, again, is like how we would see it on the balance sheet. So we're going to have, this is what we originally paid for it. This is how much accumulated depreciation we have taken after just 1 month. So this would be the net book value of it, or the book value of it, what's remaining on our books after we've taken that month's depreciation. So again, here's a little summary of all the different prepaid accounts that we could have, why we adjust them, what happens, what if we don't adjust them? If we don't adjust them, our assets are overstated and our expenses are understated. So we need to charge it to expense and reduce those assets. Okay, then now we have unearned revenue. So unearned revenue is a liability because we have not performed the service yet. So some examples, or maybe if we receive rent in advance, people buy airline tickets or even sometimes hotel stays that are like 3 months out. You may pay for a magazine subscription at the start of the year that you're going to get every month for the whole year. Or customers maybe will put a deposit down on a job. They have to give you 10% down before you're going to, put them onto the schedule. So we have to do an adjusting entry to recognize that revenue. When we actually get to perform that service and earn that revenue, the unearned revenue is going to currently be in a liability. We're going to debit it to reduce the liability and then credit the revenue to actually recognize that the revenue has been earned. So here's an example. Pioneer Advertising, they receive $1,200 for advertising services expected to be completed by December 31st. So the unearned service revenue shows a balance of $1,200 on the October 31st trial balance. And an analysis of that reveals that the company has actually performed $400 worth of those services in October. So then we're going to debit the unearned service revenue, which again was a liability. So this reduces our liability. And then we're going to recognize the revenue by crediting that for $400. Again, revenue is normally a credit balance. That's what increases it. So we are recording those. And then again, here's that little summary. So these are the examples of what type of things could come in as unearned revenue. We have to recognize them in the period that we actually perform the services. If we do not make this adjusting entry, our liabilities will be overstated and our revenues are understated. So we need to debit the liabilities and credit those revenues. Okay. So again, we've talked about the different accruals and we've talked about how we post those. So here we have some examples. So we've got, again, accrued revenues are things that we know that we have performed, but we haven't billed out yet, or we haven't collected the cash yet. So then we are going to do an adjusting entry that sets up a receivable. So we debit an asset and then we credit the revenue. So we're going to actually recognize that, hey, somebody owes us something and we really did perform the services. So here's an example. They performed services worth $200 that they did not bill yet to the customers. So then we're going to do this accrual entry. So we set up the accounts receivable for $200 and we credit our service revenue. Now then when we receive the cash of the services that it performed, we're going to debit the cash and we're going to credit the accounts receivable. Examples that we have, again, of our interest, rent, services, any type of income we have that we could get in advance. If we do not adjust it, our assets will be understated and our revenues will be understated. So we need an entry that debits the assets and credits those revenues. Then our accrued expenses are the other way. So we know we've incurred costs, but we haven't received a bill yet, or we haven't paid for them yet. So it could be interest that we're accruing every month. It could be taxes that we know we pay. We could have salaries people have worked the last few days of the month, and we know that they have, but we're not going to pay them till next month. So then we're going to recognize that we have a liability. So we credit that, setting that liability up, and then we're going to recognize that we have an expense. So we debit that expense. So here's an example. If they have a 3-month note that starts on October 1st, but it's not going to be paid again for 3 months till the end of 3 months, but they know that they have to pay a rate of 12%. So this is our interest equals principal times rate times time formula. So this is our principal, the face value of the note. This is our rate, the 12%, and this is our time. Our time is always in terms of 1 year. So this is 1 month of 12 months. So, and then how I do that is I put it all right in my calculator. So I put in 5,000 times 12% or 0.12 times 1 divided by 12. And that'll equal the $50. And then we'll debit the interest expense for $50 and we'll credit an interest payable. And we'll do that every month for those 3 months. So when this note ends up being due, we not only owe the $5,000, but we will owe $150 in interest, 3 months times that $50. Accrued wages, you got to kind of pay attention to how many days are left in that month. So if it's telling you that they get paid and they're paid on the 26th, and they get, they're paid for a 5-day work week of $2,000 or $400 a day, then we look down here and say, okay, well, there's 3 days left in October that are not going to get paid till November. So we need to accrue these 3 days. So if it's $400 a day, we're going to multiply that by 3, and we're going to record that to payroll expense. So again, those are our examples. These are, again, we know expenses that have been incurred but have not been paid or shown as a liability. Our expenses are understated, our liabilities are understated. So our entry is to debit expense and credit those liabilities. Again, a nice summary. So it's always good to go back to these because you will have test questions that ask you these relationships. So it's good to understand those. I'm going to skip through, I think, these do it exercises and move to our next objective. So we have the trial balance here. This is our adjusted trial balance. So it's after we've made these adjusting entries. Then now from this, we can prepare our financial statements. So once we've done our adjusting entries, we can prepare our income statement, our statement of retained earnings, and our balance sheet. So again, here you can see them going in. Here's our trial balance. All of our revenues come into our income statement. All of our expenses come into our income statement. Our revenues less our expenses provide our income. Our income rolls down into our statement of retained earnings. Our dividends paid are on the adjusted trial balance. Those reduce that net income. And then this is our retained earnings that will roll into our balance sheet. So then our balance sheet, all of our assets are pulled off of that adjusted trial balance and brought into our asset section. The liabilities and the owner's equity are all brought into the balance sheet. And then our retained earnings again comes in from the statement of retained earnings. And we always double check our assets equal our liabilities and our owner's equity. And we don't, you don't have to worry about the appendix section here either. So I'll skip over that as well, because these are these alternative approaches. So you don't have to worry about those last 3 slides.